Hey everyone, welcome back to Nadlan Forum Podcast Daily. I'm Lior, and today we're going to dig into something that comes up all the time in our community: mortgage refinancing. Now look, if you're like I was when I first got to New York from Israel, the whole topic can sound like, a puzzle with way too many pieces. So let's try to simplify it. Refinancing is basically just swapping your old home loan for a shiny new one, hopefully with better terms. Maybe you're chasing a lower interest rate. Maybe you want to shorten or even stretch your loan term. Or sometimes you're just looking to tap into the equity you've built over the years. People usually start thinking about refinancing when rates have dropped below what they're paying, or if their credit score's taken a turn for the better, or maybe because they've managed to build up a nice chunk of equity in their home. There are some other reasons too, like dropping private mortgage insurance, or switching from, say, an adjustable rate to a fixed rate. It's got to make sense for your situation, though. Timing really is everything here. If you just barely signed your mortgage and you're thinking of selling in a year, the closing costs probably don't justify the effort. You always want to do the math. Find out how long it'll take to actually recoup your costs with the monthly savings you get. That's the break-even point. I can't stress that enough. Let me give you my own example. When I first moved from Israel to the States, I'll be completely honest, I thought I understood mortgages, and wow, I did not. I went to my bank, got a quote, and almost just signed it because, well, back in Israel, you kind of just go with your bank. But here, I learned if you shop around, really compare lenders, not just your own bank, you can save a decent chunk. I landed a lower rate by going to a different lender who was running a promo. It was stressful, but that little switch saved me thousands in the long run. So yeah, always compare, always get a few options on the table. All right, so let's unpack the steps, because some folks think you just call a bank, sign a paper, and voila, but no, there's a process. First, you gotta look at your own finances. That means checking your credit score. Because honestly, if it isn't where it should be, you'll pay for it. And seeing what your debts versus your income looks like. And be ready for closing costs. They're usually 3 to 6% of your loan, which I know sounds like a lot because, well, it is. Have your paperwork, like tax returns and pay stubs, ready too. Then you pick your refi flavor. There's your standard rate and term refi, where you're basically just looking to swap out your old rate or adjust the loan term, maybe both. That's the classic one. Cash out refi is a little different. You're borrowing more than you owe and pocketing the difference, which some people use for renovations, debt payoff, you name it. There's also streamlined options for folks with government-backed loans, like FHA, VA, USDA. These are much quicker, and sometimes you don't even need a new appraisal. Next, it's time to shop lenders, like I said before. And seriously, don't just check with your current lender. Apply with a few within a couple of days so your credit doesn't get hit too hard. Look at both the interest rate and the total closing costs. Some lenders will quote you a fantastic rate, but then sneak in higher fees. Rate locks also come up. If you found a good deal and think rates might go up, locking is a good idea. But if rates look like they'll drop, you can take your chances and float a bit. Just know how long your rate lock lasts and what, if any, fees come with it. Now, in most cases, your property will need to be appraised again. Cost runs a few $100 and, well, it's never fun having someone judge your home, but it's part of the process. Some streamlined refis skip this part, but not all. And after that, review the loan documents, especially the closing disclosure. If any numbers look funny, ask. I had a client actually who nearly overpaid because something in the docs wasn't right. She caught it last minute. You pay the closing costs, sign everything, and voila. Now you have a new mortgage and a new payment schedule. One more quick thing. Always ask yourself if it's worth it. Calculate your break even. Add up closing costs, divide by the monthly savings, and see how many months to get your money back. If it's longer than you plan to stay, might not be worth it. And ask a lot of questions about fees, about timing, about whether you can close early. No question is too small here, seriously. So let's get into the pitfalls. The mistakes I see way too often, honestly. First up, people just chase the lowest rate without looking at the fine print. You gotta compare the whole cost, not just the shiny number in the ad. Not shopping around. That's another big one. I mentioned my own story earlier, but I see this all the time. People stick with their current bank out of habit, and they miss out on better deals. Another common one is extending your loan term without thinking it through. I actually advised someone once who almost refinanced into another 30-year term, even though he'd already paid down his old mortgage for close to a decade. I mean, sure, the payment drops, but you could end up paying way more in the long run. We ran the numbers together and he realized he was better keeping a shorter term. There are plenty of situations like that, so it pays to have someone double check your thinking. Timing is another piece. Some lenders require your loan to be seasoned for a certain period, like 6 months or even a year, before you can refinance, especially with cash out refis. And if your credit isn't perfect, options aren't off the table. Government-backed programs like FHA and VA have more relaxed rules and sometimes don't need a full credit check, especially with streamlined products. I've seen folks team up with co-signers or use lenders that cater to lower credit borrowers. It's not automatic, but there are paths forward. One last thing, refinancing isn't always the answer. There have been times, like last year actually, where a client was eager to refi just because their friend did it. But after we looked at the numbers, the costs outweighed the savings. Don't just follow the crowd. Every situation is unique, and if you plan to sell soon or if the closing costs are high, you might be better off waiting. As we always say on the podcast, just like we talked about in those recent episodes on market liquidity and home equity, do your homework, weigh your options, and talk to some pros if you're unsure. That's a wrap for today's episode. Thanks for joining me on this mortgage refi journey. I hope it clears up some of the confusion, or at least gives you the confidence to ask the right questions. We'll have more on real estate moves, mortgage hacks, and strategies in future episodes. So stay tuned. If you've got questions, send them my way, and I'll try to tackle them next time. Until then, this is Lior, signing off.